The dreaded term recession is buzzing again, and all eyes are on the US, the world's economic powerhouse. Now, with a slowdown in key sectors like manufacturing and a rise in unemployment, there are growing concerns about the health of the US economy. But why should this matter globally? And moreover, why should this matter to you and I? Now, as we all know, the US plays a crucial role as a trading partner, a major consumer, and a source of capital. And any downturn in its economy has a ripple effect worldwide. But is the US really heading towards a recession, or is the panic just overblown? Now, in this episode of The Third Empire, let's dive into the key signals and understand what's unfolding in the US and how it would affect us. You're watching Informed Investor, The Third Empire, an initiative by Equentis Research and Ranking. Let's begin. Now, it's that time of the year again. The word recession is making headlines, and the focus is on the world's largest economy, the United States. Now, with talks of economic slowdown brewing across the Atlantic, the ripple effects could extend far beyond the US borders, potentially reaching the Indian shores as well. But why does a recession in US hold so much significance? Because the US isn't just any economy. It's the global powerhouse, a major consumer of goods, a key trading partner, and a source of capital. Now, any tremor in the US economy can shake the global financial landscape, and India, despite its relative resilience, isn't really immune to these global shifts. So, what exactly is recession? Now, at its core, a recession is when the economy takes a downturn. Think slowdown. Think of it like this. There's less production happening, fewer jobs are being created, and wages don't grow as much, or worse, they stagnate. Now, because of this, people start spending less, which then impacts businesses. Lower spending means lower profits for companies, and to cope, they often cut back on their investments or, unfortunately, lay off employees. Now, this leads to higher unemployment, and the cycle repeats. Less spending, less demand, and the economy contracts further. Now, you might have heard that a recession is declared after 2 consecutive quarters of negative economic growth. While that's a useful rule of thumb, it's not the only criteria. In reality, there's more to declaring a recession than just checking if the GDP, which is the gross domestic product, has shrunk for 2 quarters. Economists take into account a whole range of factors. They look at employment levels, which is, are the jobs being lost and is unemployment rising? Next, they look at industrial production. Is there a decline in how much is being produced in factories and industries? Next, they also look at consumer spending. Are people buying fewer goods and services? Last, they also look at business investment. Are companies pulling back on new projects or cutting costs? Now, these are like different pieces of the puzzle that need to be put together to get the full picture. So even if the economy shrinks for 2 quarters, if other indicators like employment or spending are still relatively strong, economists might hesitate to call it a recession. Now, in the US, it's the National Bureau of Economic Research, or NBER, which is a private non-profit research group that officially declares a recession. Now, the NBER has a committee of economists who look at all these economic factors before making this call. Now, it's not as simple as flipping a switch. They carefully study a variety of data like industrial production, retail sales, personal income, and employment figures. So while 2 quarters of negative growth might be a big warning sign, it's really about looking at the broader economic landscape before declaring a full-blown recession. Now, why exactly are people talking about recession now in that case? Now, here we are in 2024 and people are starting to get nervous about a possible recession again. Why? Well, there are 2 key signs that we need to talk about. The first is something called a SARM rule. It's a pretty straightforward way to predict whether a recession might be coming, and it's all about looking at unemployment numbers. Now, the SARM rule says that if the unemployment rate goes up by 0.5% or more on a 3-month average from the lowest point that it was at in the last year, it could be a warning sign that the economy is slowing down and a recession could be on the horizon. Now, in other words, if we see more people losing jobs after a period of low unemployment, it's not a great sign for the economy. So what's happening now? The unemployment rate jumped to 4.2% in August 2024 after being at a low of 3.4% in the month of April 2023. Now, on top of that, job creation was much weaker than expected. Now, the US economy added only 142,000 new jobs in August 2024, which was way below the 160,000 jobs that experts had predicted would be added on in August 2024. Now, this increase in unemployment actually triggered the SARM rule, and the interesting thing about this rule is that it has accurately signaled every US recession since 1949. However, it's important to note that this rise in unemployment isn't just about people losing jobs. A lot of it also is happening because more people are actively looking for work, like new workers migrating to the US who haven't found jobs yet. So there's a bit more to this story this time. Next, we look at the manufacturing PMI. In the month of August, the US manufacturing sector experienced a decline in production for the first time in 7 months, according to the latest S&P Global US Manufacturing Purchasing Managers Index, or the PMI. Now, the seasonally adjusted PMI fell to 47.9, down from 49.6 in the month of July, marking a second consecutive month below the 50, which is the no change mark. Now, this indicates a modest deterioration in the health of the manufacturing sector, which is the most significant so far in 2024. Now, the downturn in manufacturing was driven by a continued fall in sales, reflecting weakened demand across the sector. New business orders declined for the second month in a row, with the reduction being the steepest since June 2023. So, how did US manage to get into this situation at all? In June 2022, the US was facing one of its biggest economic challenges in the decades, which is when the inflation had hit a staggering 9.1%, which was the highest that had been in over 40 years. Now, the prices for everything from groceries to fuel were skyrocketing. Now, a big part of the inflation goes back to the decisions made during the pandemic. In 2020, the US printed a huge amount of money, about 3.3 trillion US dollars, which was about 20% of all the money in circulation at the time. Now, this was called quantitative easing, and the idea was to make borrowing easier and keep the financial system running smoothly. Now, the Federal Reserve is like the central bank of the US. They control interest rates over there. When inflation starts rising in the US, which is when the prices of goods and services are getting higher and higher, the Fed steps in to increase the interest rates. Now, the Federal Reserve also cutting interest rates to almost zero, which is 0% to 0.25, to encourage spending. While this helped boost consumption, it only shot up inflation. Now, to bring inflation down between 2021 and 2023, the Fed raised interest rates 11 times, pushing the benchmark rate to a range of 5.25 to 5.5% levels, which are not seen in the last 23 years in the US. Now, while raising rates did help bring the inflation under control, falling to 2.5% in the month of August 2024, it also had unintended consequences. Now, when interest rates go up, borrowing money becomes more expensive for everyone. Businesses and consumers both are affected with this. Now, think of it like this. If you had a credit card and your interest rate suddenly shot up, you had probably think twice before swiping the card, right? Now, that's the idea. By making loans more and more expensive, people and businesses in the US cut back on spending, which slows down the economy and keeps inflation within check. Now, this leads to less spending and less investments, which, while good for cooling down inflation, isn't great for the economic growth. Now, the job market, which had been booming, started to feel the pinch. As businesses cut back on expansion and spending, demands for workers declined and the unemployment rate went up. Many critics argue that the Fed kept interest rates high for too long. They believe that while it succeeded in reducing inflation, the side effects on the broader economy, particularly the job market, were too severe. Now, they say the Fed should have been quicker to adjust its strategy to prevent economic growth from slowing down too much. Now, it's a tricky balancing act, as you would have understood. Lower inflation without choking the economy. Now, with the inflation back under control, the Fed faces pressure to consider easing the rates going forward from here on. So, are the recession fears really overblown is the next question. Now, it is interesting to note that most of the time, recession scares keep flaring up, but there is no finite arrival of the same as of now. While there's talks of recession, if we look at most of the macro indicators, they are pointing more towards a normalizing trend than an actual slowdown. Now, take the labor market for instance. That's one of the Fed's key metrics, and it's still in growth mode, not shrinking like we had typically expect during an inflation. Unemployment, well, it's sitting at 4.2%, which is actually down from the previous month's 4.3%. Wage growth is also at 3.8%, which is slightly higher than before. And it doesn't stop there. If you look at retail sales, consumer confidence, or even the services PMI, they're all still in the positive category. So while there might be some isolated pockets of slowdown, it's not enough to call this a broad-based recession just yet. Therefore, there is absolutely no reason to panic at this point in time, as the US economy is still going strong at the moment. So let's talk about how connected this situation is to our lives here in India, with US raising interest rates and the Federal Reserve looking to do that. Now you might be thinking, why do I need to care about the Fed sitting all the way in the US? Trust me, it has a ripple effect that reaches right here into our wallets and businesses, and even the prices we pay for everyday items. But how does the impact? Now let's say the Fed decides to hike interest rates. Higher rates in the US mean that investors, especially big ones like hedge funds and institutional investors, find it more attractive to park their money in safer, high interest places like the US bonds. This means they start pulling their money out of riskier emerging markets, and guess what? India is one of those emerging markets. Now this movement of money out of India has several effects. First, it creates pressure on the currency, which is the rupee. Think of the rupee like any other product. When there's less demand for it, because investors are selling rupees and buying dollars, its value goes down. A weaker rupee means imports become more expensive. Now here's where it hits you and me directly. India imports a lot of crude oil, which we need to fuel our cars, trucks, planes, and pretty much everything that moves. Now when oil gets more expensive, petrol and diesel prices go up, and this has a ripple effect on the transportation cost, food prices, and basically the cost of living. But it's not just about inflation. There is another layer to this. Many Indian companies, especially those with international operations, borrow money in the dollars from abroad because interest rates are typically lower there. But when the rupee weakens, repaying this loans becomes more and more expensive. Imagine you borrowed $100 at 70 rupees per dollar, but now the exchange rate has moved up to 75 rupees per dollar. You would need to pay more rupees to repay the same amount of dollars. Now this puts pressure on the Indian businesses, especially those with high foreign debt, and it can lead to lower profits or worse, defaults. Now let's flip the scenario. What happens when the Fed cuts the interest rates? Now this usually happens when the US economy is slowing down, like we just discussed, and the Fed wants to boost spending and investments. Now lower rates in the US mean that investors are less interested in parking their money there because they aren't getting good returns. So they look for higher returns elsewhere, and that's when India comes into the picture. Emerging markets like India are higher potential returns, especially in stocks and bonds. When this foreign capital flows back into India, it strengthens the rupee, stabilizes our currency, and boosts our financial markets. Now, more foreign investment also means more money flowing into the Indian economy, allowing them to borrow more cheaply, expand, and grow further. Now, this can lead to more jobs, more innovation, and overall economic growth. You'll often see that stock markets rally when foreign investors start pouring money back into India. Now, a Fed rate cut lowers borrowing costs for US companies, allowing them to spend more on technology, services, and upgrades. The Indian IT companies, which serve many US clients, stand to gain from this because their order books could fill up quickly. Now, when US companies spend more on IT, Indian firms like Infosys, TCS, and Wipro benefit. This could directly boost the performance of the Indian IT stocks, making them an attractive bet for the investors at this point in time. So what exactly is happening right now? The upcoming US Federal Reserve interest rate cut has been creating quite a buzz in the Indian stock markets. It's not the first time we've heard speculation about a Fed rate cut, but this time it seems more likely than ever. The much anticipated shift could finally be on the horizon, with the next Fed meeting scheduled on 18 September 2024, when we expect the first reduction in interest rates in the US. So why is it so important for India? Now, as we discussed above, when the Fed lowers interest rate, it makes borrowing cheaper in the US, which in turn drives investors to seek higher returns elsewhere, and emerging markets like India are the prime targets. Now, this influx of foreign investment could mean a boost to the Indian stock market. Money flowing into the Indian equities from global investors usually lifts the market sentiments, which benefits companies across various sectors. Now, the expected rate cut on 18 September may kickstart a cycle of easing, which could provide tailwinds to the Indian economy by attracting more foreign direct investment, making credit cheaper for businesses in India who borrow from the foreign banks, and helping to boost consumer confidence. While we can't predict exactly how the Indian market will respond, Historically, a Fed rate cut has been seen as a positive for the Indian equities. It will be crucial to watch how this plays out, especially with the Indian economy already showing signs of recovery and resilience in the face of global headwinds. With that, this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.